Those of you on dating apps know that one of the most cliched questions that you can get asked is, what are you looking for? If the RBI was on such an app, the answer would have probably been, I am serious about inflation, but also looking for some fun with growth. And this is probably the world's shortest and most inappropriate description of the flexible inflation targeting mandate that the RBI has. So, the RBI raises interest rates to control inflation. And it does that because the higher interest rate ultimately reduces the level of demand in the economy. And when people demand lesser goods and services, in theory, inflation should reduce. So the RBI's job is a bit like a cook with one hand on the stove regulator. It has to increase or decrease the flame in such a way that the economy is cooking at just the right temperature. And that right temperature for India is an inflation of 4%. That is the official target of the RBI. Well, technically it's a 2% band around the 4% target. So inflation should remain in the 2 to 6% range. That is the RBI's core responsibility. And you can see that overall it has done a pretty good job keeping inflation in this range. It has only been post-pandemic that inflation has crossed the 6% upper limit and the RBI has struggled with its goals. But look, it's not strict inflation targeting. It is flexible inflation targeting. And what this means is that yes, the primary target is inflation, but you, the RBI, are also responsible for growth. You can't let it fall off the cliff, which actually came into play during COVID. Supply chains were disrupted, inflation shot up, but the RBI didn't raise interest rates mechanically in response. Instead, it said, wait a minute, my mandate is flexible inflation targeting, so let me use that flexibility to alternately focus on the massive slowdown in growth caused by the lockdowns. And so, when COVID struck India, the RBI cut its benchmark repo rate, the rate to which all interest rates are linked to, from 5.15% to a low of 4%. Now, COVID came and went, but the inflation it introduced stayed on. And you can see how inflation shot up to 6.6% in 2020, the year of the pandemic, mildly fell to around 5% in 2021, and then surged to a high of 6.7% in 2022. But here, RBI changed course. RBI said, "Bahut ho gaya flexibility. Let me get back to my primary job of controlling inflation." And so it raised interest rates from 4% to 6.5%. The level it is maintained throughout last year, well, up to the time of filming this video in September 2024. So why is it that we are now talking of the RBI again potentially cutting interest rates? What has changed now? And why has the RBI so far been so reluctant to cut? Does their reluctance come at a cost? Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Arudeep Nandi, and today we debate if interest rates are headed lower in India. As always, if you like what you see, please hit the like button. And if you haven't already, please do subscribe. And if you'd like to support me, the super thanks button is below. First things first, why are markets talking of rate cuts now? Well, simply put, because inflation has come down. You can see this from the monthly data, that inflation has cascaded down from close to 6% in 2023 to averaging less than 4.5% in the past 3 monthly readings. Which means that even though the RBI has kept the policy interest rate constant at 6.5% since last year, at that time, inflation averaged 5.7%. So the real interest rate, the interest rate adjusted for inflation, was 6.5 minus 5.7. So around 0.8%. But this year, inflation is trending closer to 4.5%. So the same 6.5% interest rate effectively means that the real interest rate is 6.5 minus 4.5 or close to 2%, which historically is quite high for India. So within a year, in real terms, interest rates have gone up from 0.8% to around 2%, squeezing economic growth. And so people are starting to wonder, अब कुछ ज़्यादा नहीं हो रहा है? RBI, you are keeping interest rates so high to control inflation, but inflation is already getting close to the target of 4%. Granted, it's not quite there, but at 4.5%, it's kind of close. Then do you really need to keep interest rates so high and pressurize the economy? And by the way, other major central banks are already starting to flip. While the US is still not in a recession, and please do watch the episode of The Bond Economist where we discussed this, the link is in the description. Their central bank, the Federal Reserve, has now almost committed to starting with rate cuts from September onwards. The European Central Bank, ECB, is also widely expected to cut later this month, and the UK has already cut rates in August, indicating that globally we are moving out of the high inflation, strong growth scenario to one where inflation is moderating and growth is slowing. And so before it gets worse, central banks globally are trying to normalize interest rates from the elevated levels that they had been raised to after the pandemic. And so in this environment, it is natural for markets to start expecting that India too might go down the same path. But so far, the RBI and specifically its Governor Shaktikanta Das has gone above and beyond to argue that please quit any delusions that the RBI is going to reduce interest rates anytime soon. For those of us who regularly monitor the RBI when the governor and the rest of the 5 monetary policy committee members meet once every 2 months to vote on the policy rates, when Governor Das gives interviews to the financial press, when he addresses conferences, and it is striking how vehemently and forcefully he pushes back against any notion of rate cuts in the near future. But why is this the case? What is the governor really afraid of? For this, it is important to understand what goes into India's Consumer Price Index or CPI inflation. Broadly, there are 3 components: food, fuel, and core. Food inflation, as the name suggests, comprises of the inflation in cereals, pulses, sugar, milk, vegetables, fruits, eggs, meat, etc. Fuel comprises primarily of LPG, electricity, and kerosene prices. And the rest, the core basket, comprises of things like clothing, footwear, household goods and services, transport-related costs, phones, mobile charges, recreation, house rent, personal care items, so things like toiletries, haircuts, jewelry, etc. Now, you don't really need to be an economist to figure out that the core basket is the one that intuitively is going to be most closely linked to the level of demand in the economy. And hence, it's the most sensitive to interest rates. After all, if onion or wheat prices go up because, say, rainfall was less in a particular area or there's been flooding somewhere else, then there's little point in the RBI raising interest rates because that won't bring down inflation. But your demand for laptops, cars, two-wheelers, pressure cookers, shirts, saris, suitcases, barbers, even household help will depend on the state of the economy, will depend on your ability to pay for these goods and services. And hence the level of interest rate that the RBI is setting matters for this basket. So here is the RBI's dilemma. On the one hand, food inflation is really elevated. And on the other hand, core inflation is down to its lowest levels in a decade. Now, part of this is because input costs for companies have come down sharply. But it could also indicate that demand isn't as strong in the economy. One of the biggest puzzles that economists covering India are currently grappling with is that how is it that on the one hand GDP data is telling us that the economy is growing at around 7% or so, but on the other hand demand seems to be so weak that core inflation is at its lowest level in years at less than 3.5%. So if core inflation, the inflation that is linked to RBI's interest rate policy, is so low, then shouldn't the RBI be cutting interest rates? Well, Governor Shaktikanta Das thinks no, for 3 key reasons. First, yes, you may argue that prices of onions, dal, eggs, fish, etc. are not linked to interest rates, but the RBI says, so what? Our mandate is 4% inflation, which includes everything. So we can't say that, hey, core inflation has come down, so our job is done. Also, in the past, higher food prices have spilled on to core inflation. The broad logic is that it doesn't matter what causes inflation, but eventually inflation causes inflation. Let me explain. In theory, if inflation comes from food items, higher overall inflation means that you expect things in the economy to become more expensive going forward. And so your inflation expectations start to go up. But if you expect higher inflation tomorrow, you will start demanding stuff today, thinking it's going to be more expensive later. And so today's inflation starts to rise. Finally, higher inflation also means that people may demand higher wages. So firms may then have to raise prices of their products in response, leading to higher inflation, which then has a vicious cycle of people demanding more wages. It's called wage price spiral. The fear of these have led to the RBI governor saying that it is too early to let down our guard and reduce interest rates. Which brings us to point number 2. Overall inflation for FY25 is expected by the RBI to average 4.5%. So Governor Das keeps saying that, hey, my target is 4%. So I'm still not there. I need inflation to sustainably stay at 4%, and we are still far from that. And third, in the RBI's judgment, growth is strong. It predicts 7.2% GDP growth in FY25. It expects good monsoons to lead to a revival of rural demand this year. It sees companies starting to invest and the government focused on infrastructure spending and strong balance sheets of banks and corporates. So the broad rationale is that as long as the country's growth is fine, there's little need for me, the central bank, to reduce interest rates to rescue it. Instead, isn't it better that I kept the heat on until inflation is fully taken care of and it's back to 4%? Finally, and this is not what Governor Das says, but what many people in the market argue or speculate, that in India, banks are struggling to get deposits to match the loans that they are churning out. The RBI itself has increased the regulatory costs attached to banks aggressively doling out unsecured consumer loans. So ultimately, the end game is that credit growth has to come down to sustainable levels if you can't increase deposit growth enough. In short, if banks are struggling to get funding through deposits, then how long can they keep up the pace of giving funding to others? But if the central bank now starts cutting interest rates, then credit growth won't come down. In fact, there is a risk of it picking up. So the RBI should keep interest rates where they are. Now, these sound like pretty convincing arguments. So what are their flaws? One, you can't just ignore falling core inflation even if you don't target it explicitly. For instance, suppose, hypothetically, core inflation was really high, say 6% or 7%, and food inflation was really low, minus 2%, say. So maybe overall inflation remains close to 4%, the target of the RBI. Higher core and very low food inflation, this is the opposite of the situation today. In such a scenario, will the RBI say, hey, my target is overall inflation and that is at 4%. So it doesn't matter what core inflation is, I'll still cut interest rates. No, that would be a fatal error. Because if core inflation is elevated, it means that there is a real risk of the economy overheating. And in such a situation, it would be madness to cut interest rates to stimulate the economy even further. So core inflation does matter. And the fact that currently core inflation has been falling like gravity is acting against it is something that should be flashing on RBI's radar. Also, you can't forever keep saying, oh, high food inflation will spill on to core inflation just because it's happened in the past. You need to see what the situation currently is, where food inflation has been high for a sustained period of time. And the fact is that despite this, despite household inflation expectations being elevated, core inflation hasn't picked up. And in fact, rural wage growth adjusted for inflation is contracting. So the spillover effects that the RBI seems to be so obsessing over, maybe to quote Shakespeare, turn out to be much ado about nothing. Secondly, this confidence on growth may be bordering on overconfidence at this stage. We have in fact done a detailed episode of The Bond Economist on this. Please do check the link in the description. And the verdict on economic growth seems to be mixed. Yes, rural demand is picking up. Yes, we've had good monsoons, but the state of overall consumption demand in the economy is kind of shaky. Urban demand is struggling. It is a matter of concern that car sales are slumping and inventories are at really high levels. And across the board, products and services catering to better off premium customers are doing well, while demand from the poorer, worse off households is trailing behind. Yes, corporate investments have picked up, but a strong, broad-based revival seems debatable, suggesting that demand may not be as strong in the economy. Besides, as the global economy slows down, there will be a natural spillover impact on our export-oriented sectors. The point is that with the RBI solely focusing on the rosy outlook of 7% plus GDP growth and ignoring the creaking, groaning sounds emerging from the economy, it might be under the impression that keeping interest rates high carries no collateral damage. But the fact is that by focusing too much on food inflation, you are running the risk of over-tightening and creating an additional squeeze on the economy. And remember, monetary policy typically works with long lags. So if you cut interest rates by 0.25% or 0.5% now, it's not like the economy will suddenly pick up pace. A rate cut today will take several quarters to impact the economy, be it on growth or inflation. So a central bank has to be forward-looking. Instead, if it waits for growth to first slow before it starts cutting interest rates, well, then it's already too late. Because by the time your rate cuts will actually start to kick in, economic growth would have possibly slowed even further. Finally, for those in the market who argue that higher interest rates need to be maintained so that the credit growth and deposit growth come to a better equilibrium, well, let's go back to the basics of what RBI's mandate is. It is flexible inflation targeting, which basically means that its job is to set interest rates to control inflation with a lookout for growth and nothing else. And nothing else literally means nothing else. It means you cannot tweak interest rates to influence credit growth or to incentivize depositors. You cannot tweak interest rates to ensure that the currency is at a particular level. Nope. The moment you do that, you're diluting your objective of inflation control. If you want to control, say, credit growth in the economy, then do what you're already doing. Place curbs on banks lending to sectors you don't want them to lend to. Take regulatory steps to control these imbalances. Using interest rates as that one tool to target everything in the economy is a mistake. It is the equivalent of slapping someone hard because you saw a mosquito on their face. But look, all said and done, if you really read between the lines, the RBI has carefully given itself room to cut interest rates if need be. It has kept saying that we have to keep interest rates high as long as inflation aligns to the 4% target. Rather conveniently, it hasn't clarified what it means by align. So it can very well wake up one day and say that the current outlook of 4.5% inflation this year effectively means that it is already aligned to the target. Or who knows, maybe the RBI wants to see inflation actually reach 4% before changing course. Either way, the RBI's current message is that it won't act. But sometimes not acting is an action in itself, and all actions eventually have consequences. For more such insights, like, share, and subscribe to The Bond Economist.